This is Daybreak Asia. We're counting down to Asia's major market opens. And Haidi, this just feels like a very busy hour, really, that's coming upon us now because we've got the Bank of Korea decision that's due. And then we're also expecting GDP figures and the MAS statement in just a few moments' time.
And not to mention, of course, the possibility of more moves in the yen, right, as we continue to get that jawboning from Japanese officials. We've been getting them every morning at about this time. The question is where that line in the sand remains. And as you say, given we have the BOK, we have that MAS decision as well as GDP data from Singapore, a lot of this coming down to broad-based weakness that we see in Asian currencies now.
Yeah, it's all about King Dollar that's really coming through. But as we said, that focus on the eco numbers and what they're telling us about the outlook for this region. And just right now, we've had Singapore coming out with its GDP figures and the MAS statement as well. So they're saying there's no change to the width or the centre of the currency band. They're going to be maintaining the prevailing slope of the policy band as well. So the MAS saying that the economy is expected to strengthen over the course of 2024. They actually see core inflation at 2.5 to 3.5% for the remainder of this year. And they're saying that the CPI all inflations item, again, 2.5 to 3.5%. The economic growth, they're saying as well, the MAS, it's becoming more broad-based, but they do need to remain vigilant to risks to that, not only to the growth outlook, but also to price pressures as well, and that resurgent outlook for price pressures we're seeing elsewhere. But they do say that the current monetary policy settings do remain appropriate at this point in time. So that's the MAS. As we said, no changes coming through to their slope, the width or the centre of the currency band. And you're seeing the Singapore dollar there flat. As we see as well, Singapore first quarter GDP rising 0.1% on the quarter. That's actually weaker than the estimate, which had been for growth of 0.5% instead. But let's get reaction to this immediately. Bring in Prashant Bayani. He's Asia CIO at BNP Paribas Wealth Management. And Prashant, I'm interested for your take. No change coming through at this point in time from the MAS.
Yes, that's pretty much as expected. I think you had a little bit of a blip in inflation in February, but export data in the region is starting to pick up. And given kind of the inflation issues, particularly the U.S., it makes sense to obviously be on hold and not change any policy for the next quarter.
And we are continuing to watch for just some of the commentary around, of course, the MAS decision that the core CPI stepped down in fourth quarter before falling further into 2025 is the expectation that the settings are needed to keep restraining effect on inflation. So when they talk about core CPI expected to stay elevated in the immediate quarters, but stay broadly on that moderating path. And Prashant, this is kind of the commentary that we're hearing from a number of central banks, right? We're trending in the right direction when it comes to inflation management, but there are still upside risks and there is still some ways to go. How much concern is there, given, of course, Singapore is very externally vulnerable and externally open, that if we see things like geopolitical changes, if we see things like elevated oil prices, that is going to be a blip for the inflation picture and the growth picture in Singapore?
Yeah, I think with Singapore, there's domestic and there's global. Clearly, it's geared to the global economy. And there were GST rises as well, which we have to get through. But that will start to fade in the second half of the year. Of course, energy prices are a bit of a wild card. Our forecast on fundamentals is oil Brent between $85 to $95, and now we're firmly in that range. Clearly, if we break out to the upside, that could delay rate cuts, but not our base case. But overall, we are in a period of disinflation, but it's stubbornly slow. And that's how I think people will be cautious in the near term.
All right, Prashant, stick with us because we do want to get more broader views coming through from you, but we've just had the markets opening as well, so we do want to note what's happening with Japan, Korea and Australia in particular as we come online. But this is the outlook here we see for Japanese equities that are moving to the upside. It does track what came through in the US session, that focus on big tech in particular ahead of earnings that start later today with the financial names in the US, Citi, Wells Fargo among them. So this is the state of play here, of course, tracking what comes through with the Japanese yen very closely. You're above that 153 mark. more jawboning coming through, as we're saying. Haidi, it does typically come through at this time of the day. But Suzuki is saying that this is the finance minister saying that the weak yen can accelerate import-driven inflation, which is a big concern there in Japan at this point in time. They're not going to be ruling out any sort of options against what they could see as excessive FX moves. So watching that closely there, the Japanese yen holding unchanged at this point in time. But let's also shift on, because Korea market's starting to trade, and not just the focus on the BOJ, but the BOK this hour, given we've got the rate decision that's due. Broad expectation is we're going to see rates on hold. We did actually have jobs figures out in the last hour. Pretty tight labour market. That was sort of the key takeaway, and that does give the BOK time, perhaps, just to wait a little bit longer, Haidi.
Taking a look, Belle, when it comes to the start of trading, which is about 5 minutes or so in the start of the staggered session here in Australia. A little bit of downside there, about 1/4% softer. We're seeing some declines when it comes to Aussie and Kiwi bonds, as well as we see Treasury futures headed for a second weekly decline amid these ongoing concerns about the state of US inflation still remaining elevated, even with that softer PPI print coming in overnight. The Aussie dollar is losing a little bit of ground, 65.35, even as we don't see that much of a move when it comes to the broader dollar index. Taking a look at treasuries, as I mentioned, it does look like we are really seeing a downside for the week, for a second week, in fact, as we continue to kind of see bond traders shifting their thinking to 5% yields, a no rate cut world, as we continue to hear that sort of management of expectations from Fed speakers, including the latest being Susan Collins overnight.
Yeah, well, Haidi, let's get more on those perspectives, the moves we're seeing in bond yields and that sort of repricing coming through as well. Prashant Bayani, he's Asia CIO at BNP Paribas Wealth Management. He's still with us. And Prashant, given the repricing we're seeing going on, do you think we're in an environment now where we've actually got to think about rate hikes again?
Yeah, we definitely think it's a little early to think about rate hikes. But there has been obviously more of a U.S. phenomena of stubbornly high inflation on the services side that we saw in the CPI a few days ago. PPI was a bit better overnight if you really look at the components, and that bodes better for PCE. But clearly, the services side is more stubborn. If you look at the number of components that have brought inflation above 4%, that's picked up, things like auto insurance, healthcare, that's stubbornly up with events. But overall, I think the Fed now will have to be very sensitive to the data points, and that means in the short term, more interest rate volatility. Yields have repriced for the latest news, and clearly we've moved now the market pricing in just 2 cuts for 2024.
And then how does that sort of affect your thinking then around big tech valuations? Do you need to sort of be shifting away from some of those names into other sectors of the market instead?
Yeah, it's about broader diversification. A big theme of ours, even in January, is we saw big concentration in markets, whether it's the U.S. or even Europe. And what we've been saying is we've been overweight sectors such as healthcare, financials in Europe, for example, materials, selected energy. All these sectors had high single-digit, low double-digit yields and returns year to date. So now they, in the last 6 weeks, have actually starting to outperform technology. And the only way you could get a higher market, for example, in the U.S., is seeing a broadening of the market and the breadth improve. So that's the good news. And that's because actually, if you look at U.S. growth estimates year to date, they've actually picked up on GDP. So yes, inflation is a challenge in the short term, but growth is also higher. So some of that inflation is driven by higher growth. That means better nominal GDP and better corporate profits. So that's why equity markets have actually fared fairly well, even with the number of rate cuts coming down year to date. And that's important to note in terms of your equity view. But yes, we would look at a broader set of sectors rather than have the concentration that we saw last year.
I wanted to get your thoughts on China, because broadly there seems to be more of a shift towards feeling positive about this market, given how cheap valuations are. Is this something that looks perhaps a little bit more compelling at this point?
Yeah, I think we're probably through the worst of it. January, we saw some panic lows. Since then, we've seen GDP estimates being cut by the street. We think the China Communist Party has obviously put in 5% as a GDP estimate in terms of their forecast, and the street's below that, 4.6 consensus. So it's now a low bar to beat. The key is how much stimulus we get between now and the end of the year. The good news is the PMIs, the last 4, actually the highest since February 23, and consumption has lagged. But if you look at Lunar New Year and the recent festivals, actually consumption per capita is above, finally, 2019 levels. But we won't get a convincing breakout till the property market bottoms. That's a missing factor. But in the PMIs, you can see exports have picked up. The manufacturing side has picked up. So some components of the economy are in recovery. So we think we're through the worst of it. Within that, of course, you want to be broadly spread, along with SOEs that pay dividend yields where you're aligned with the policies of the government, for example, and domestic consumption recovery plays.
Prashant, I'm interested as well. We've seen that big move coming through, also partly driven by expectations of Chinese demand, but for base metals in particular, how are you thinking about this area of the market?
Yeah, base metals, we've also been overweight. I think the one that we've really been focusing on is copper. Dr. Copper, as they say, it's a lead indicator of the economy. And with manufacturing picking up, that bodes well. And there's a triple play in copper. It's geared to EV, of course, the electric vehicle growth. It's geared to AI. Data centers are very energy intensive, require a lot of copper. And for that copper use is really through the grid. So electricity grid has to be rewired both for renewables as well as in greater AI use. So there's a lot of secular reasons why there'll be copper demand. Then the supply side is also challenged. We've had some larger mining areas of the world disappoint on the production side. So between those two factors, we think copper, I should say, should recover and continue to rally in 2024.
All right, that was Prashant Bayani there, Asia CIO at BNP Paribas Wealth Management. And we are just bang on 10 minutes into the session so far for Aussie, South Korean and also Japanese stocks. But what we're tracking this morning is the price of iron ore. Actually, it's a little bit under pressure. But think about the run-up that we've had this week because it's been higher for the past 4 out of the past 5 sessions. So again, it is that demand outlook coming through from China. And even when you just look at the dollar amount, we had seen iron ore just last week trading below that $100 a tonne mark. Now we're back closer to that 110 level. But that is the state of play for some of the big Aussie miners as we come online. Let's shift on, take a look at another story we're tracking today. We had a big Bloomberg scoop actually out overnight talking about the Apple essentially adding in its own chips to computers or overhauling its Mac lineup. We are just tracking some of those names. And then EV stocks, the other one to take note of in particular, given we had Ford also pushing through a price cut. It is really that sort of startup sell-off that we're starting to track as well. But there's some of the supplies into that name. Again, a little bit under pressure so far, Heidi.
And Belle, of course, as you say, it's a very busy hour, it feels like. And this is one of the reasons why the Bank of Korea widely expected to keep rates unchanged. The parliamentary elections delivered that blow to President Yoon. We'll get some analysis with ING later this hour. Before that, though, maritime security topping the agenda at that trilateral summit between the US, Japan and the Philippines. We'll get the highlights and the outcomes from that meeting next. This is Bloomberg.
China's current external stance and military actions present unprecedented and the greatest strategic challenge, not only to the peace and security of Japan, but to the peace and stability of international community at large.
The United States defense commitments to Japan and to the Philippines are ironclad. They're ironclad. As I've said before, any attack on Philippine aircraft, vessels, or armed forces in the South China Sea would invoke our mutual defense treaty.
President Biden and Japanese Prime Minister Fumio Kishida speaking there in Washington, and of course looking at this trilateral meeting between the US, Japan and the Philippines. They're saying they're committed to a free, open Indo-Pacific. Let's get more on this summit, of course, which included the Philippine President Ferdinand Marcos Jr. Our Tokyo Bureau Chief Isabel Reynolds joins us now. So, Isabel, talk about the significance of this and how so much of this, of course, is looking to counter the growing assertiveness we see from Beijing.
Yes, absolutely. This trilateral summit, the first of its type in Washington, was very much all directed at China. So it's all about strengthening those maritime ties, strengthening ties between the coast guards and the naval ties as well. And as you saw just now, President Biden used this as an opportunity to underscore this ironclad commitment to the defense of both countries. And that comes as, of course, tensions are very much growing in the South China Sea, somewhat, of course, as well in the East China Sea, where Japan has its own separate territorial dispute with China, but very much trying to bring both of these countries, both of these allies, into this kind of lattice or network of alliances that the Biden administration is trying to build across the region to counter the growing strength of China.
Yeah, and it's interesting, well, perhaps not from Beijing's perspective, but what's been the response so far from China, given that sort of rhetoric that we're hearing from the US, Japan, and also the Philippines?
Right. Well, as you say, I don't think there's been time yet for the Chinese to respond to the trilateral summit in itself, but we saw similar language coming out of the bilateral summit between Kishida and Biden the previous day. And it was very obvious that Beijing was not happy about that. They said they had made formal complaints to both sides and said that, of course, that this relationship between Japan and the US should not target other countries, nor should it harm their interests. On the other hand, this comes ahead of a reported summit between Japan, South Korea and China in Seoul next month. So we'll have to see how that part of the relationship pans out in the coming weeks.
As well, we also saw Kishida giving a speech to Congress on Thursday. What was the main message that he wanted to get through?
Right. I think the overall message we got from that was that Japan is looking ahead to the election in the US and is concerned about how a potential return to power by Trump could affect its alliance with the US or affect the US kind of view of alliances in general. So Kishida's message was very much, we need the US on the global stage. We need you to be playing a great part in world affairs. But at the same time, Japan is here and it's playing its part. So he talked up Japan's increase in its defense budget and how Japan is prepared to play a less kind of a reticent role in global affairs and stand shoulder to shoulder with the US.
That was our Tokyo Bureau Chief Isabel Reynolds. And from the tensions over disputed territory, of course, to the battle for global supremacy in chip making, Bloomberg Originals has been looking at how the US dropped the ball on its chance to take the lead in the technology underpinning the AI revolution. Here's a preview.
This is arguably the single most important machine in the world right now, technologically, economically, and geopolitically. Without it, the global economy would slow, the pace of technological advancement would stutter.
EV technology is the only reason that we have iPhones that are as fast as they are, the reason that we have this AI revolution with chatbots and ChatGPT.
They cost $200 million each, and of the 200 or so that exist today, just a handful are on US soil. The device has turned the only company that produces it, the Dutch firm ASML, into Europe's biggest technology firm. And that's despite the fact that much of the early work on the technology originated in the US. What's more, successive US administrations have had to scramble to ensure that none are sold into China.
This is a story about where physics meets business and has a massive impact on the world's economy.
So how did the United States manage to miss out on this colossally important piece of tech?
And subscribers can see that Bloomberg Originals documentary in full right now and on the terminal on Bloomberg.com. It'll be up on the YouTube channel a little later. Plenty more to come here on Daybreak Asia. This is Bloomberg.
If our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission were to further increase our confidence that inflation is converging to our target in a sustained manner, it would be appropriate to reduce the current level of monetary policy restriction. In any event, we will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level of and duration of restriction, and we are not pre-committing to a particular rate path.
European Central Bank President Christine Lagarde there speaking at a press conference after the ECB left rates unchanged, offering a bit more nuance though around commentary in terms of expectations around inflation. It was really those comments about the fluctuations expected in the inflation outlook that saw the euro hitting those session highs. Take a look at how we're setting up when it comes to European futures. At the moment, we're seeing broad positivity actually. Euro Stoxx 50 futures up about 0.6%. We did see a down day in the Thursday session after those hawkish comments from Fed Reserve officials really dampened some of those earlier optimism that we saw over rate cuts expectations from the ECB and from Christine Lagarde. German DAX futures up by just about 0.5% there as we continue to watch to see really whether we see another day where a lot of these bond proxy utilities, renewable stocks seeing more gains, as well as oil stocks, energy stocks in Europe as well, hitting some record highs, a high since at least 2010 after the report about a potentially imminent Middle East escalation taking place. Belle.
Yeah, and Heidi, just some other global developments we're tracking this morning as well. FTX co-founder Sam Bankman-Fried will appeal his conviction and 25-year prison term for committing a multi-billion-dollar fraud. The 32-year-old filed a notice of appeal in federal court 2 weeks after his sentencing. It's unclear on what grounds Bankman-Fried intends to appeal. The largest US airlines are asking the Biden administration to block new flights for Chinese carriers, citing what they call Beijing's anti-competitive policies. The Airlines for America trade group and several unions have made the plea in a letter to the Secretaries of State and Transportation. Flights between the US and China are growing, but they do remain well below the average 340 per week before the pandemic. US federal agencies have been ordered to analyse emails, reset credentials and secure Microsoft Cloud accounts over concerns about possible Russian hacking. The directive was issued early this month by the US Cybersecurity Agency and made public on Thursday. The agency accuses a Russian state-sponsored group called Midnight Blizzard of trying to compromise some Microsoft customers. President Biden is moving to block oil and gas development in millions of acres of Alaska's North Slope, with an initiative that could be finalized within days. The administration says it needs to balance oil development with protecting habitat for polar bears, migratory birds and caribou. Companies with leases in the region, including Santos, ConocoPhillips and Armstrong, have objected to the plan. Taking a look at FX this morning, we're half an hour into the trading session for equities, but FX here, some interesting moves to note. You've got the Japanese yen, of course, very much the one that we're tracking, given the risks of intervention, possibly from Japanese government officials. So far this morning, that watch has really been on any sort of jawboning that's coming through, and Suzuki lines actually dropping in the past 40 minutes or so, essentially talking about the excessive moves that they're seeing, and also that Japanese government officials do remain prepared to act. So tracking that closely, they're above that 153 mark. Otherwise, the other one to note is the Singapore dollar here holding fairly steady. We earlier had an MAS decision coming through, and the key read-through from that was that we saw them maintaining the slope, the width and the centre of the currency band, so not really any changes there. We did actually see GDP numbers as well, growing by 2.7% in the first quarter, but below the average analyst estimate or economist analyst. As well, the BOK, watching the Korean won there, a bit weaker, but we do have the Bank of Korea decision that's due perhaps in the next 10, 15, 20 minutes. We'll check it, but certainly watching that very closely. We had jobs figures out earlier suggesting that the labour market is saying that the BOK has a bit more time to stay on hold.
All right, ahead of the Bank of Korea decision, we're not expecting any major changes, but of course watching for the nuances, right, ahead of the rate decision where they are expected to hold. We also did get that jobless rate rising to 2.8%, in line with expectations, but still perhaps a little bit of a warning over what we're seeing with the broader labour market, given a lot of concerns already with certain segments of the labour market in Korea, namely when it comes to youth unemployment. We're seeing broadly softer trading across Korea ahead of the BOK, 0.7% lower. We're also seeing downsides for Australian stocks as well, about 0.3% lower. Also watching, of course, earnings coming through, and of course we're looking to bank earnings in the US kicking off in the Friday session, but here in Asia as well. One of the bellwethers, particularly when it comes to households and consumption, fast retailing, of course, the Uniqlo maker falling as we saw the results miss, namely on weakness in China sales. So we're seeing declines of the most since at least the start of April. The second quarter operating income missing analyst estimates on the weaker sales in China, and further to that, analysts are expecting that sales slump to continue as they try to shift that key market to the European market instead. Well, KKR's co-CEOs say China's consumer sector does still remain a sweet spot despite the sluggish recovery, but they're avoiding politically sensitive sectors such as AI. Joe Bay and Scott Nuttall told us exclusively about their current focus in Asia, including the revival in Japan.
Asia for us is really an area we've been building and growing for 2 decades now, since 2005, and an area where we as a firm have a really, really dominant position, the largest alts manager in Asia today. So we've grown from 18 billion of AUM to 65 billion of AUM in the last 5 years in Asia, organically, to give you a sense of the type of growth. It's the fastest growing part of the world today. 60% of global GDP growth is coming out of Asia. The most exciting consumer trends are coming out of Asia. So it's a natural place for us to be focused as private equity, as infrastructure investors, as real estate investors. In Japan in particular is exciting. It's around 40% of our business in Asia is Japan. Just given its 2 decades of deflation, it's coming out of this long economic morass. And the implications for Japan are profound in terms of where savings are going, in terms of corporate governance reform, the opportunity for us to really buy great non-core businesses from big conglomerates. So it's a very target-rich opportunity for us.
Yeah, and it's not just in our asset management business. If you look at the life insurance and annuity market, in the U.S. it's a $4 trillion market. In Japan, it's $3 trillion. So it's a massive market across a lot of what we do. And so we see opportunities to expand in multiple parts of KKR in Japan.
A lot of people are focused on Japan right now. KKR has a more dominant position. There's also a lot of focus on China and what to do with that. And a lot of people are saying we're getting out. You do have a significant presence in China. How do you think about how that lives, given the geopolitics of the moment, which are highly uncertain?
Well, listen, our approach to China, I think, has been consistent since we started our business there. We have 3 offices, Beijing, Shanghai, and Hong Kong. So we are committed to that market. But the complexity of investing in China is obviously much higher today. Our focus over the last 2 decades has really been focused on the consumer segment of China, the growing middle class, the urbanization trends in that marketplace, and that's the sweet spot of the opportunity for us. So we've invested in retail companies, branded consumer goods, healthcare. We are not leaning into these high growth areas that are geopolitically sensitive, like semiconductors, like AI. So we've avoided a lot of the areas that are currently creating a lot of turmoil in the market, and we're sticking to our knitting, consumer services.
That was the KKR co-CEOs Joe Bay and Scott Nuttall speaking exclusively with our colleague Lisa Abramovich in New York. And of course, as KKR was saying, there are very exciting opportunities in Japan. And in fact, the government as well is pouring more money into the chip industry in the country. One sector is also getting a boost from the nation's booming chip market. Our senior Asia stock reporter Hideyuki Sano joins us from Tokyo. And Hideyuki, it's often interesting when you have that sort of AI trade, that boom, you start to look for some of the picks and the shovels in the trade as well. But this one, perhaps you could take a little bit literally.
Exactly. I mean, it is almost like a gold rush in the 19th century. So we're having a lot of investment in the semiconductor sectors. And that's because, yes, the Japanese government is subsidizing building plants here. And also there's geopolitics, which means that a lot of companies now feel that there's it's better to have some production in Japan as well. And the yen is also cheap. So in terms of cost, it does make sense to build factories here. All of this is helping to change the dynamics in the Japan's construction sector. I mean, if you look back just a few years ago, no one had thought that companies would bring back a semiconductor making factory in Japan. So what's happening is that the construction companies are now having a strong bargaining power in terms of price negotiation, and that's particularly strong in case of so-called subcontractors, which generally speaking is not the weakest part of the, they're not the strongest player in the sector, but now they can simply walk out of any bad deal. So the share prices of some companies have doubled in the past year or so.
Are we really seeing an earnings recovery though?
Yeah, that's a good point. So far, I mean, the earnings have been recovering, but not as much as some other sectors. For instance, if you look at food companies, they're doing much better. But on the other hand, the conditions seem to be improving quite sharply in the past couple quarters. And if you look at the Tankam Corporate Sentiment Survey by the BOJ, you can see that the construction companies are now saying that they're very it's becoming easier to hike their prices, and that is sort of bucking the overall trend where many companies are now saying that they're getting less bullish about price hikes. So this is really the sector that seems to be in the sweet spot at the moment.
Are there any risks, though, to that sort of optimistic outlook, do you think?
Yeah, I mean, this is a sector that has been basically stagnant for many years, and there's good reason for that. I mean, it's probably well known, but the population of Japan has been declining, and it's expected to continue to decline for the foreseeable future. So basically, there'll be fewer building projects, fewer homes, and fewer roads, bridges, etc. So the overall picture is not that great. That said, they have now found a steady stream of cash flows, so that would help at least mitigate the risks for this sector.
Our senior Asia stock reporter Haidi Kisano there. Well, investors are gearing up for first quarter earnings from major US banks, JP Morgan, Citi and Wells Fargo, all reporting on Friday. Bloomberg's Shanali Basak has more on what to watch, starting with net interest income.
At the end of last year, Wall Street players took turns predicting a slowdown after a record haul of more than $250 billion on expectations that the Fed would start cutting interest rates. But 3 months later, that hasn't happened. In fact, economists are reducing the amount of expected rate cuts. So when it comes to net interest income, JP Morgan is set to win big, partly because of its size compared to peers. Expect earnings of about $23 billion in the first quarter. That's almost 7 times more than the industry estimated average. Investment banking has benefited from strength in U.S. equities, debt issuance, and deal making. And again, JP Morgan has the edge with a projected $1.8 billion in fee revenue, up 10% from a year before. Punching above its weight, though, is Bank of America, a rival which is likely to report $1.3 billion from investment banking, up 14% from a year ago. And finally, we'll want to hear any updates about how big banks plan to counter exposure to commercial real estate problems. Wells Fargo is the one to watch here, as its share of CRE lending is the highest versus its largest peers. Bloomberg Intelligence says a 2% write-down to CRE loans would reduce Wells Fargo's 2024 earnings per share by about 13% before accounting for reserves that have already been set aside. I'm Shanali Basak for Bloomberg News.
From Wall Street banks to India's lenders who are scouring for trading talent as the economy booms. The employment market is so strong. Stories are circulating of million-dollar salaries, private bankers demanding 50% pay hikes. Our Asia stocks reporter Ishika Mukherjee joining us more with today's big take. So, of course, we know the India economic boom success story has been one of the biggest drivers across this region. And we're seeing that play through to financial labour markets and labour conditions.
Absolutely, signs of expansion are everywhere, from the big names like BlackRock, HSBC and UBS, who left India in the 2010s. These names are coming back to the country now and looking at expanding at a clip that they've never expanded at before. And even from market makers, foreign market makers are coming back to it, are thinking of expanding to India for the first time. So Optiva is setting up its office here in Mumbai. And then you have Citadel, which hired for Gurugram. So these examples are everywhere, and the banking sector overall in India grew its headcount by the most in more than a decade last year in the 2023 fiscal year. All this is coming accompanied with pay hikes. So you have desk heads at algo-driven firms and strategies getting paid $1 million annually. And let me tell you, $1 million go a lot further in Mumbai than they would in New York. And then you have private bankers getting 50% pay hikes when they ask to move firms. So there's really a lot of exuberance right now in the market around expansion, hiring, and pay.
Ishika, I think $1 million should go far wherever you are in the world, perhaps for most people. But I'm wondering, given you're seeing these sorts of salaries coming through and just the sort of pay hikes as well, how sustainable is this trend?
That is a good question. I think the authorities are well aware that, there are pockets of over-exuberance in the market, for example, in the IPO space. So they've been clamping down on IPO financing, brokers over-lending to retail clients. There's also some measures that the RBI, the Reserve Bank of India, is coming up with which affect certain parts of the currency derivatives market and sort of throttle speculation there. And funds have also stopped taking fresh money for investing overseas, and these are exchange-traded funds in particular. So you can see authorities coming in to sort of, control the optimism in the finance sector right now, because they also don't want unbridled growth, and they don't want pay to get to a point where it becomes unsustainable, right? And then you see the cycle turn for the industry overall, and that's obviously not going to be good for new job seekers or people who are looking to move.
Yeah, and then there's, I guess, the risk perhaps that India maybe doesn't open up perhaps in the way that has been expected by some of these people that are moving in. Is there a risk of that happening? And also perhaps we start to see China picking up again that market and you see fund flows shifting back.
Absolutely, you're very right. That is a risk. And India has sort of flip-flopped on its opening up in the past, where it eased currency restrictions and brought them back on for good reason, so the rupee doesn't devalue. But it still has reintroduced controls on capital in the past. Of course, now there are a lot of things that are moving in a systematic direction towards opening up for India, such as Gift City, which is a financial hub, a special economic zone in Gujarat, where they've gotten rid of currency controls completely, and other forms of ease of doing business have improved in ways that you've never seen in India, really. And all that's leading to finance professionals in India looking set for a 10% pay hike this year, and that's more than their rival hubs in Singapore and Hong Kong, and this is really new. So you're seeing a lot of trends that are fresh and coming to India for the first time. So this is an exciting space to be in the near term, at least.
All right, that was our Asia stocks reporter Ishika Mukherjee there. And let's take a look at some of the other corporate stories we're tracking still in the financial sector, because Morgan Stanley shares fell the most in 5 months on Wall Street. That's after a report that US regulators are scrutinizing the firm's efforts to prevent potential money laundering by wealthy clients. The Wall Street Journal says the SEC and the Treasury's Financial Crimes Enforcement Network have sought information on certain clients outside the US who raised red flags and on the bank's policies to address them. The Fed Reserve was already known to be looking into those money laundering controls last year. Taylor Swift's music is back on TikTok, despite an ongoing dispute between her record label and the social media platform. The timing coincides with the upcoming release of Swift's next album, which is due next week. Universal Music Group pulled its music from the platform in February after failing to come to terms on a new licensing agreement. And we'll have more to come on Daybreak Asia as we head through the morning session, watching the Kospi. They're a little bit under pressure, but of course that big countdown to the Bank of Korea decision that could be due just in the next few minutes. This is Bloomberg. All right, we're just over 45 minutes into the session so far, and taking a look at Korean assets in particular. We're on a bit of a countdown at this point in time of the day, given we've got the Bank of Korea decision that's due, expected to keep its policy settings unchanged. That's something that's been seen or forecast by all 23 economists in our survey. Ahead of that, again, just some of the sectors we're watching in particular, the tech stocks, you can see they're rising. That's the tech-heavy KOSDAQ with the gains that we had in big tech overnight on Wall Street. And the Korean won there just a little bit under pressure. But let's get more on the BOK decision. As we said, that countdown to the release, and bring in Minju Kang. She's senior South Korea and Japan economist at ING. And I guess, Minju, it's just something that we're hearing from a lot of central banks. They're cautious about pivoting away too soon.
Yeah, actually, it's the same case for the BOK too. Since the March BOK meeting, actually, inflationary pressure has increased, and also the survey data show that inflation expectations also rose. So, but in the meantime, then in Korea case, overall the growth conditions remain quite solid, thanks to the strong exports driven by the chip export. However, it also offsetting the sluggish domestic growth. So in that sense, the BOK will we believe that will keep their hawkish stance for a while until they see this bumpy inflation path ahead is how to evolve. But we believe that they continue to express their confidence that inflation path is slowly converging to the target of 2%. But also they admit that the inflation path in last mile will be bumpy. So in that sense, we believe that in this today's decision will be more likely, keep the policy rate at 3.5% as it is.
Against that sort of backdrop, then, perhaps it puts more of an emphasis on the press conference that follows the decision. So what sort of signaling would you expect to hear from that?
As I said, inflation has gone up. So I don't think that, the BOK governor, Lee Chang-yong, would, pre-commit to any policy for, any policy direction yet. However, we have to keenly listen that, there is some kind of minor views that, open up to a rate cut in, 3 months of time. That is the one thing that we have to monitor. And also, secondly, if there will be any wording changes in the statement, should be another thing. But
we actually do have the decision coming through. The Bank of Korea, as we've been talking about, is expected, leaving the key interest rate unchanged at 3.5%. All 23 economists surveyed had forecast the Bank of Korea to hold that rate at 3.5%. And obviously the nuances, the communications around their reasoning is going to be more key. What else are you looking out for in terms of the balance of risks for the Bank of Korea?
Actually, because of the recent price pickup, and, the government efforts to curb inflation will continue. And also we believe that, tight monetary condition will come to play. However, this recent price pickup is mainly due to the more supply side issues rather than the demand side. So the BOK can downplay a little bit on the recent price pickup. However, they are going to be very cautious about, and also they acknowledge the upside risk for the inflation for near term. And and also in addition that there will be some reshuffle in the committee members. So the terms for two members which are considered the hawkish members, their term will expire soon after this April meeting. Then we have to see how this reshuffle will play out in the future's BOK's monetary policy decision and stance.
In terms of the timing of the Fed, obviously there's risks in potentially front-running the Fed for any central bank, but how significant do you see the pass-through in terms of the impact through the won, through trade, through financial conditions for what the Fed does?
Yes, we believe that the BOK will probably, yes, it is one of the major factors that will closely watch is the Fed's actions. However, more important thing is, the macro conditions for two countries are quite different for now. And the BOK will more focus on domestic growth issues. So, we believe that even Fed will, their rate cuts will maybe begin on September. But we still believe that, the BOK can act first before, the Fed, start their cutting race.
We see the won holding losses against the dollar with that rate unchanged, a key interest rate being left at 3.5%. Min-Joo, I wanted to get your views when it comes to the labour market data that we had. Obviously, we're seeing a little bit of a lift when it comes to unemployment. How concerned are you, particularly with the sort of legacy worries over youth unemployment in the country?
Yeah, that is one, the overall. Still, the unemployment rate is below 3%, which is lower than historical average. So at this point, probably is not a big concern for the BOK. However, looking at the details, yes, the youth unemployment rate is pretty high, but it also partially due to the timing of the the season that lots of graduate comes out to the market, and then probably there's a time gap to have their jobs. So we see that the unemployment rate will gradually rise a bit in the second half of this year, but still we believe that the overall conditions for employment will remain quite solid.
Min-Joo, before we let you go, I want to also get your views on Japan as well, given we've been monitoring the weakness in the Japanese currency very closely and the jawboning coming through. And just this morning we heard from Japan's Finance Minister Suzuki saying that a weak yen can accelerate import-driven inflation. That's a fairly well understood risk, of course, in the currency market. But how closely are you tracking that in terms of the growth outlook for Japan?
I think actually the weak Japanese yen has been working as a positive factor for the growth because the corporate earnings were boosted by the weaker Japanese yen. But at the same time, yes, the weak Japanese yen is pushing up some inflationary pressures. But in Japan's case, it is in a way that is more they want to see more inflationary pressures to sustain, and that's why we believe that unless the pace of Japanese yen weakness is too fast or too speculative, I believe that that's not going. I mean, there are going to be more bubble interventions, of course. However, these some high level of Japanese yen will continue remain until the Fed's rate cut begins. So that will have some positive impact on the GDP side, but also have another play to push up the inflation as well for the Japan's inflation numbers.
Min-Joo, really great to have you with us. Min-Joo Kang there reacting from ING on that Bank of Korea decision. This is Bloomberg.